we had something happen that we would have been waiting for, hoping for, praying for, and that is that we got another rate cut actually hit the CRE market from the Fed. I want to break down what the Federal Reserve's recent interest rate cut actually means, how that decision works its way through the financial system, and why the commercial real estate market still needs more rate relief to truly stabilize. There's excitement, obviously, about the rate cut, but there's also some confusion. So let's walk our way through the mechanics behind the headlines. When the Fed cuts rates, they're lowering the federal funds rate, the rate banks charge each other for overnight lending. That is not the same thing as mortgage rates or commercial loan rates, but it sets the floor on how expensive money is across the entire economy. Think about this. When the Fed lowers that rate, banks' cost of capital comes down. Treasury yields often move lower. Benchmark rates like SOFR begin adjusting, and the credit market generally loosen. It's a chain reaction, and commercial real estate sits downstream in that process on the chain reaction. But here's how the single Fed move might actually impact borrowers. Step one, banks' short-term borrowing costs fall. Step two, lenders are able to reprice their own cost of funds and their risk models. Step three, benchmarks like SOFR, which many CRE, commercial real estate loans are tied to, begin to drop. And step four, that leads to lower floating rate debt payments. And then step five, as confidence returns, lenders expand loan programs and adjust their own underwriting. That's how a Fed announcement eventually becomes a real world interest rate for borrowers trying to refinance or acquiring an existing property in the CRE space or business space, anything. But that trickle down doesn't fully materialize after one cut. It takes a series of cuts for lenders to meaningfully change their position. That's why we still need more rate relief. Most existing commercial loans were made when interest rates were dramatically lower. Today, many of those owners are facing DSCR failures, refinance shortfalls, negative leverage, maturing debt priced for a completely different market, and they're getting pressure from the lenders to do something about that. And there's nowhere to go with those loans. So if you can't get a new package loan or refinance your existing loan, what's going to happen? So a modest rate cut from the Fed, we're not turning aside or snarking at that. It's helpful, but it doesn't magically make these numbers work. We need continued rate reductions for borrowers and lenders to meet in the middle again. And this is how lower rates improve loan products. As rates move downward consistently, lenders respond. They start offering higher proceeds on bridge and permanent loans, more attractive spreads, increased interest-only terms, and wider availability of capital for value-add projects that many operators, sponsors, and syndicators look for all across the country. But lenders don't roll out those better products based on a one symbolic rate move. They need to see a trend, stability, predictability, a clear direction, and the Fed has to continue to lower interest rates. So here's the bottom line, our opinion. The Fed's rate cut is a positive first step. And it has been a positive first step the last few quarters with the reasonable cuts, but they're not enough. And if we want to meaningfully stabilize commercial real estate, reduce distress, and reopen liquidity in the debt markets, we need more rate cuts delivered consistently. This moment marks the beginning of improvement, not the end. But if this Fed stays on this path, the CRE market will finally start to breathe again, and opportunities will start to reemerge for owners, operators, and investors. And we could probably start to see another bull run happen again. So hopefully this was helpful for you. Let's hope that the Fed continues to cut rates. For those of you that are looking for deals all across the country, Godspeed.